Once upon a time, boomers made a bet. They believed that their ticket to a comfortable retirement lay not in pensions nor the stock market, but in housing. That's right, boomers believed your home is your biggest asset. And in their prime, this actually made a lot of sense, because by being a homeowner, you were building up equity you could one day cash out, could borrow against it as it grew in value, and pass it down to your children to create generational wealth. Owning a home wasn't just a place to live, but it was the ultimate financial asset, your savings account, your safety net, your wealth engine, and your legacy. However, eventually, what began as America's favorite asset turned into the largest financial bubble in modern history. The financial system collapsed, making the stock market lose half of its value. Home values plummeted by 30%, and over 10 million Americans lost their homes. And for boomers nearing retirement age, this wasn't just a market crash, but it was the collapse of their entire retirement plan. The equity they spent decades building vanished, their savings evaporated, and for many, they were back to square one as in-debt renters. And so the question of this video is, why did boomers bet their future on housing, and why did it backfire? And in this video, that's the story I want to tell, because boomers' decision to view their house as their ultimate investment didn't appear out of nowhere, but it's a centuries-long tale that transformed housing from shelter into speculation. And so in order to understand how it all went wrong, we need to turn back the clock 150 years ago, back before housing wasn't viewed as an investment, but simply a place to live. Chapter 1, when homes were just homes. For most of humanity, housing wasn't seen as wealth. Land was seen as wealth, but not the structure sitting on it. Instead, for most of history, homes were viewed in a very practical way. They were a place for shelter, safety, and family. And back then, homes weren't something that you bought to build wealth, but they were something that you built in order to survive. Homes were simple, often constructed by the families themselves, made from local materials, and shared by multiple generations under one roof. A home wasn't a financial strategy, but it was the foundation for a secure life. However, as we entered the 20th century, the idea of borrowing to buy a home or having a mortgage appeared, but it looked nothing like it does today. The first mortgages were short-term loans, often just 5 years, required enormous down payments, sometimes 40 to 50%, and were mostly interest only, meaning your monthly payment didn't reduce the principal at all. And when the loan period ended, you had to pay the entire balance or refinance. These early mortgages weren't accessible for most people. Instead, for the average person, owning a home meant years of saving, borrowing from relatives, or slowly building it piece by piece. There was no system for the average person to buy a home. However, once we entered the 1930s, that system would appear. Chapter 2, the birth of the 30-year mortgage. By the 1930s, due to the Great Depression, this old mortgage system was collapsing. By 1933, nearly half of all mortgages in America defaulted. And that's when the government stepped in to try to provide some relief to restore Americans' confidence in the system. And probably one of the biggest transformations occurred in 1934, when the Federal Housing Administration was created, whose mission was to expand homeownership, improve housing standards, and stabilize the market. And one of the biggest programs that they created was mortgage insurance, which guaranteed lenders that if a borrower defaulted, the government would cover the loss. This policy gave banks the confidence to start lending again, and very quickly, the modern American mortgage was born. The FHA encouraged banks to give out longer loans that were 20 to 30 years. Down payments were dropped to 10 to 20%, and because loans were insured by the government, interest rates stayed low and stable. For the first time in history, ordinary families could buy a home, make manageable monthly payments, and actually pay down the principal over time. And as we entered the 40s, with World War II ending, home ownership would very quickly become a symbol of the middle class. Chapter 3, Housing as the American Dream. So we've now entered the part of the story where the first boomers are appearing in 1946. And this is a time of unprecedented prosperity. The war was over, the economy was booming, and America was building again. Millions of veterans were returning home, and to help them restart their new lives, the government passed the GI Bill, which provided education, job training, and most importantly, low-cost mortgages to veterans. For the first time in history, the government was offering a pathway for the average American to buy a home because under the GI Bill, veterans could buy a home with little to no down payment, receive low interest rates, and the government took on most of the risk, so banks were more willing to lend. And this is the birth of the modern middle class. Home ownership rates jumped from about 44% in 1940 to nearly 62% by 1960. And developers rushed in to meet this demand, and the first ever suburb was created, called Levittown, in New York, that offered affordable, uniform homes with schools, shops, and parks nearby. And eventually, home ownership became a symbol of the middle class. The house, the car, the white picket fence, and the dream of a better life for your children. However, still at this point, housing was not seen as an investment, but it was seen as stability, community, and a place to raise children. And so boomers grew up in a world where owning a home wasn't just a goal, but it was the definition of success. But as boomers came of age, the world around them was changing, and they would end up creating their own meaning of home ownership. Chapter 4, Housing to Hedge Inflation. As we entered the 70s, for the first time, Americans started to see their house as an investment. And that shift was driven by one thing: inflation. That was hitting double digits throughout the 70s. And so holding cash was pointless because it lost its value. And so Americans needed a new way to protect their wealth, and housing seemed like the perfect option. Real estate was one of the few assets that outpaced inflation. From 1970 to 1980, the median home price went from $23,000 to $64,000, or a 175% increase, whereas inflation went up 103%. And in addition, homeowners with fixed-rate mortgages were insulated from inflation. As their wages stagnated and prices climbed, their mortgage payments remained the same, whereas renters saw their monthly costs increase. And on top of that, the government was rewriting the tax code that made home ownership even more attractive by introducing mortgage interest deduction, which allowed homeowners to write off the interest they paid on their loans. For example, if you made $12,000 a year and paid $2,000 on interest on your home, your taxable income would only be $10,000, another benefit renters didn't get. And so as we entered the 70s, boomers were starting to buy their first homes. But to them, buying a home didn't just mean stability, but it meant beating inflation, saving on taxes, and quietly building wealth. And by the 1980s, Wall Street would take this a step further. Chapter 5, Housing as a Financial Product. As we entered the 80s, home ownership was a wealth builder for the boomers, but for the banks, it was a different story. You see, throughout the 70s, mortgage lending was dominated by savings and loan banks, which were basically the neighborhood lenders. But due to the high inflation throughout the 70s, these mortgages were starting to kill them. They were stuck with fixed-rate, low-interest mortgages as interest rates rose, and were forced to offer higher savings rates to customers so people didn't withdraw their money to buy treasury bonds. And many of these banks were starting to collapse, and when Washington saw this, their solution was deregulation. They allowed banks to offer new kinds of mortgages, invest in riskier projects, and expand to new markets. And the most significant thing that came from this deregulation was called the mortgage-backed security. And so let me explain what this is. Back in the 70s, getting a mortgage was pretty simple. You went to your local bank, they gave you a loan, and you paid it back over 30 years. The bank carried most of the risk. However, eventually, this shifted. Instead of the bank holding on to your mortgage for 30 years, instead, a bank could issue a mortgage, then immediately sell it to an investment bank or government agency, and then that entity would bundle thousands of these loans together in a single financial product called a mortgage-backed security, which investors could then buy and collect a share of the profits when people made their monthly mortgage payments. And at first, these were pretty safe. They were issued by government-sponsored entities. And if a borrower defaulted, the government would step in and cover the loss. However, eventually, this entered the private sector, and the investment bank Salomon Brothers and Bank of America created the first private mortgage-backed security. These were riskier mortgages, ones the government wouldn't touch, but that risk came with the potential of higher returns. This is when Wall Street officially enters the housing game, and this new system completely changed the incentives. Mortgage brokers were rewarded to sell as many loans as possible. Wall Street was rewarded for packaging them into securities, and investors were rewarded for chasing higher returns. And over time, this really got out of hand. Small-town banks that once made home loans were now speculating on commercial real estate, junk bonds, and anything that promised higher returns. And by the end of the decade, over 1,000 saving and loan banks had collapsed under the weight of bad real estate bets, costing taxpayers $160 billion. It was the first warning sign that when housing becomes speculation, someone ends up losing. And as we entered the 1990s, housing wasn't just a financial product for banks, but it became a source of cash for everyone. Chapter 6, Housing as an ATM. By the 90s, many boomers had built some equity in their home, and at this point, they weren't just living in their homes, but they were starting to withdraw from them. For the first time, they were cashing in on some of that equity that they had built up, and the first way they were doing it was through refinancing. Homeowners could refinance at a lower rate and take out equity at the same time. For example, imagine your home is worth $150,000 and you still owe $80,000. You have $70,000 in equity. So you might take on a new mortgage at $120,000, pay off the existing $80,000, and pocket the remaining $40,000 that you can use for other things. This created the idea that your home could generate liquid money. Another way people were cashing in was through home equity loans, which allowed you to borrow a lump sum using your home equity as collateral. For example, like in the previous example, you have $70,000 in equity. A bank might let you borrow 80% of that, or $56,000, and you can use it to buy whatever you want, and you'd pay it back like a smaller second mortgage. It was like unlocking your home value without ever having to sell it. And the third way that people were cashing in was through home equity lines of credit, or HELOC, which is a line of credit that allows you to borrow against the equity you have on your home. For example, if you had $70,000 in equity, the bank might let you borrow 80% of that, like a credit card, to buy whatever you wanted and you would pay it back. And doing this stuff seemed perfectly okay because home values always went up over time. I mean, if you bought a home for $82,800, it would be worth $130,000 10 years later. And so people felt richer while their income remained the same. And so many of these boomers who were tapping into the equity for the first time were starting to think that this could be their retirement plan. Instead of having a pension like their parents or learning about this new 401k, they could simply buy a home, build equity, and cash it out later, whether that's downsizing and living off the difference, borrowing against it when needed, or renting it out as income. It's like saving without having to save. Even if you didn't have that much money, your home would always be there taking care of you because homes only go up in value. And as we entered the 2000s, home ownership was becoming possible for everyone, whether they could afford it or not. Chapter 7, The Housing Gold Rush. As I said earlier, due to deregulation in the 80s, private mortgage-backed securities appeared that allowed investors to buy a piece of your mortgage. And eventually, this investment became so attractive that everyone around the world wanted a piece of the American dream. Your mortgage in Topeka, Kansas might be owned by someone in Tokyo, Japan. And by the year 2000, home ownership was reaching all-time highs at 67%. It was this money-making machine, and Wall Street couldn't get enough. The more people that owned homes, the more loans they could bundle and sell. But eventually, they ran out of qualified buyers. And so in order to add more fuel to the fire, lenders started to lower their standards, and they started to offer loans to people that didn't qualify for the previous loans. And these were called subprime mortgages. They were borrowers with low credit scores, unstable incomes, or no savings. These people might not pay back their mortgages, but nobody cared because of the incentive structure. Mortgage brokers were rewarded to sell as many loans as possible. Wall Street was rewarded for packaging them into securities, and investors were rewarded for chasing higher returns. They kept issuing more loans because it was just adding more fuel to the fire. Wall Street just wanted more mortgages that they could package and sell to investors. And by 2004, home ownership reached its peak at 69.2%. And although these loans were given to people that might not pay them back, on paper, they look like extremely safe investments to investors. They were rated AAA, which is the same rating a US Treasury bond gets, so it was a no-brainer for investors to take a bigger return. Everyone was getting rich. However, as the old saying goes, when everyone's thinking alike, somebody isn't thinking. And eventually, this subprime mortgage lending would create this massive housing bubble. And in 2008, it would burst. Chapter 8, the crash. Now, these subprime mortgages were often given out at very low teaser interest rates that would reset years later. For example, a family paying $1,200 a month could suddenly start paying $2,000 once the interest rate resets. And because many of these borrowers were already stretched thin, when their payments doubled, they defaulted. And eventually, as these rates reset, the entire system would come crashing down, and the first spark went off in 2007, when New Century Finance, one of the biggest subprime mortgage lenders, went bankrupt. And as more and more of these interest rates reset, foreclosures were everywhere because people couldn't afford to pay their mortgage. And when borrowers defaulted, mortgage bonds stopped paying investors, making the bonds worthless. And this created a domino effect. Bear Stearns collapsed in March of 2008 and Lehman Brothers in September, which was the biggest bankruptcy in history. Wall Street was collapsing, but for Main Street, it was devastating. Home values plummeted, 10 million Americans lost their homes, and unemployment surged to 10%. And for boomers who were in their late 40s or early 60s, this devastated them even more. Many boomers refinanced at its peak value in the early 2000s, and when home prices crashed, they owed more than their homes were worth. And so many sold their homes at a loss, losing the equity they had made, and cashed out their 401ks, destroying their entire retirement plans. I mean, according to the Center of Economic and Policy Research, late boomers had their net worth drop by 45%, while early boomers saw it drop by 50%. And for boomers, this happened at the worst possible time. A 35-year-old could ride out the downturn, rebuild savings, and wait for home values to rise again. But a 58-year-old planning to retire in 5 to 10 years didn't have enough time to recover. And then we enter Chapter 9, the biggest liability. For most of their adult lives, boomers were told your home is your biggest asset. However, after the crash, it was more looking like your home is your biggest liability. You see, many of these boomers who lost their home also lost all the equity they built over decades and were back to square one. And for those who still had homes, due to declining values, they were underwater. Their mortgage debt was greater than the market value, and so they couldn't sell, couldn't refinance, and couldn't retire. The same homes that were supposed to be their ticket to financial freedom were the same homes that kept them trapped. Many postponed retirement, downsized, or became long-term renters. They were finally entering their golden years, but they had either lost it all or were stuck, not knowing what to do. And in 2025, many boomers find themselves in two very different scenarios. Those who still owned property saw their home values double from 2012 to 2022 and became millionaires on paper. But those who sold are either renters or just starting to pay off a mortgage in their 60s in the most expensive housing market in history, with little to no wealth. It's the unfortunate reality that many boomers are living with. And so I want to finish this video off with Chapter 10, Where Do We Go From Here? Alright, another boomer story in the books. As we've discussed in this video, boomers came of age being told that your home is your biggest asset. And for a while, that belief worked. Home values rose, equity was built, and borrowing against it became second nature. But over time, those same habits, refinancing, leverage, and speculating, left many right back where they started, broke at the finish line of their working lives. And so the question is, what do we do with all this information? Well, I think if there's just one lesson that this story teaches us, it's that financial systems evolve drastically over time, and people often get caught up in the middle, paying the ultimate price. You can make all the right decisions, but in the end, the same system that you trusted might end up betraying you. And so as always, I want to finish off this video with 3 takeaways that I learned from researching this topic. 1. A genius plan looks stupid really quick. In hindsight, it seems absurd to bet your future on your house, but at the time, everyone was saying this was the smartest thing to do, and for decades it worked. But the thing about financial systems is that they work great until they don't. What looks like the smartest investment today can become the biggest financial bubble tomorrow. The truth is, no plan is genius forever. What works today might not work tomorrow. And so don't be too quick to judge people, because what you believe might be safe right now might end up looking very stupid for the next generation. 2. Timing is everything for retirement, but it is out of your control. For many boomers, the difference between retiring comfortably and retiring broke boiled down to one thing: timing. 2 people can make the same choices their whole lives: buy a home, save, invest, and do everything right. But if one retired in 1995 and the other in 2008, their outcomes would be worlds apart. That's the cruel truth with retirement. You can control your own habits, but you can't control the economy around you. And sometimes you are just at the wrong place at the wrong time. And finally, nobody is looking out for you in this world. If there is just one more thing that this story proves, it is that nobody is coming to save you. The government didn't protect homeowners, the banks didn't protect their customers, and Wall Street didn't protect the people whose mortgages they gambled with. Everyone was just looking out for themselves, and that's how the world works, and I hate to break it to you, but that's how the world is always going to work. And so if there is just one lesson that you take from this story, let it be this: your financial security is your responsibility. Thank you so much for watching. If you enjoyed this video, please give it a like, subscribe for more like it. I'd love to hear your thoughts in the comments section. And if you want to hear another very interesting story about why manufacturing left the United States and went abroad, give this video a watch next. And with that, muchas gracias. Que tengan un buen día. Nos vemos, chicos.